For my Finance 381 class, we were asked to do a financial analysis on 3 companies to see what companies we would offer a short-term loan to, a long-term loan to, and what companies we would like to invest in. The 3 companies that I chose is Hornbeck Offshore Services, Yum Brands Incorporated, and Sanderson Farms. The first company we're going to talk today about is Hornbeck Offshore Services Incorporated. As you can see, for short-term loans, the current ratio in 2014 was 4.6. The cash ratio was 2.23, and the quick ratio was 4.60. In 2013, however, the current ratio was 6.10, the cash ratio was 2.23, and the quick ratio was 6.10. In 2012, the current ratio was down to 2.13, the cash ratio was 1.68, and the quick ratio was 2.13. For long-term loans, in 2014, the total debt ratio was 0.53, the equity multiplier was 2.13, and the debt-to-equity ratio was 1.13. In 2013, the total debt ratio was about the same as 0.54, the equity multiplier was 2.19, and the debt-to-equity ratio was 1.19. In 2012, the total debt ratio was 0.56, the equity multiplier was 2.26, and the debt-to-equity ratio was 1.26. For the question if I would like to invest in this company, I needed to figure out the return on equity, the return on assets, and the profit margin. In 2014, the return on equity was 6.64, the ROA was 1.55, and the profit margin was 13.77. 2013, the return on equity was 9.05, the return on assets was 4.08, and the profit margin was 14.44. In 2012, the ROE was 3.31, the ROA was 3.08, and the profit margin was 8.24. So my thoughts on this company. Since Hornbeck Offshore Services has the highest current ratio, cash ratio, and quick ratio, I believe Hornbeck should be able to pay off their debt if needed to be. I also believe this would be a wise investment to make a short-term loan to this company since they have the highest current ratios, cash ratios, and quick ratios. For a long-term loan, the total debt ratio, the equity multiplier, and the debt to equity are relatively low. I will not offer a long-term loan to this company. Having the lowest ROA and ROE of the 3, I will not invest in Hornbeck Offshore. The next company that I chose is Yum Brands Incorporated. For short-term loans in 2014, the current ratio was a low 0.68. Cash ratio was a 0.24, and the quick ratio was a 0.56. 2013, the current ratio was a 0.75, a cash ratio of a 0.25, and a quick ratio of a 0.62. In 2012, the current ratio was a 0.84, cash ratio of 0.34, and a quick ratio of 0.71. For long-term loans in 2014, the total debt ratio was a 0.81, equity multiplier a 5.17, and a debt-to-equity ratio of a 4.17. 2013, the total debt ratio was a 0.74, equity multiplier at a 3.83, and a debt-to-equity ratio of a 2.83. 2012, the total debt ratio was the same, the equity multiplier was a 3.90, and the debt-to-equity ratio was a 2.90. When looking to invest in this company, the ROE was a high 56.61, the ROA was a 12.34, and the profit margin was a 7.91. In 2013, the ROE was at 50.51, ROA at 12.32, and a profit margin of 8.34. In 2012, the ROE was 80.31, ROA of 17.90, and a profit margin of 11.71. My thoughts on Yum Brands. The current ratio, cash ratio, and quick ratio are just too low to offer a short-term loan to. With the highest total debt ratio, equity multiplier, and debt to equity of the 3 companies, I believe it will be not a good investment to offer a long-term loan to. And Yum! Brands Incorporated is interesting to invest in. I like how the ROE is the highest of the three companies, but I do not like how their profit margin is decreasing each year. So I will not be investing in Yum! Brands Incorporated. My third and final company is Sanderson Farms Incorporated. The current ratio is a 3.46 in 2014. The cash ratio was a 1.12 and a quick ratio of 2.17. In 2013, the current ratio was a 2.67, a cash ratio of 0.53, and a quick ratio of 0.89. In 2012, the current ratio was 2.93, a cash ratio at a low 0.21, and a quick ratio of 0.47. In 2014, the total debt ratio for Sanderson Farms was a low 0.19, equity multiplier of 1.24, and a debt to equity ratio of 0.24. In 2013, the total debt ratio was 0.27, the equity multiplier was 1.38, and the debt to equity ratio was a 0.38. In 2012, the total debt ratio was 0.39, the equity multiplier was a 1.63, and the debt to equity ratio is 0.63. My investment analysis on Sanderson Farms: in 2014, the ROE was 30.87, the ROA of 24.47, and the profit margin is at an 8.98. In 2013, the ROE was 20.78, the ROA at 14.34, and a profit margin of 4.87. In 2012, the ROE was 9.90, the ROA at 5.85, and a profit margin of 2.26. The thoughts on Sanderson Farms is their current cash and quick ratios are high enough for me to offer a short-term loan to. With the lowest total debt ratio, equity multiplier, and debt to equity ratio, Sanderson Farms is the best company of the three to offer a long-term loan to. And for the third, will I invest in this company? I will invest in Sanderson Farms because of their high ROE and ROA, and their profit margins are increasing each year. Thank you.